Next, we're going to talk about the very last part of our balance sheet, and that's going to be stockholders' equity, guys. And we know what stockholders' equity consists of. Stockholders' equity is the residual. It's really the net worth of the company, and we know it consists of two parts, right? So the stockholders' equity. Stockholders' equity is broken down into two parts. First part of stockholders' equity is paid in capital. And the next part of stockholders' equity is retained earnings. And we know what paid in capital is. Paid in capital consists of any funds that we generate from our shareholders. And I can give you the list of accounts in the order for the paid in capital, right? So our paid in capital accounts. Preferred stock is always first. Why? Because they get preference to anything. Anytime dividends come, these guys get it first. If the company has to liquidate, these guys get their money back. So they get first preference to everything. But the disadvantage is that their stock doesn't appreciate as much in value as common stock would. So in terms of you trying to get capital gains off the stock, it would be totally different opportunities as it would with common. So preferred stock, that account goes there. Then you will list your common stock. Then you will list your paid in capital excess of par, right? Paid in capital excess of par preferred stock. Then you will list your paid in capital excess of par common stock. And I could quickly explain to you what those last two accounts are, those paid in capital excess of par for preferred and common. Basically what happens is whenever you issue shares of stock, you always credit that capital stock account at its par value. A par value is just an arbitrary amount that comes out whenever you initially organize your company. Most of the par values that I've seen are normally $1, no more than $2 or something like that. But of course, you sell the value of your stock higher than that based on what the market expects it to be. But in terms of financial reporting, you always record your capital stock at its par value. Okay? So I'll give you a quick example. Let's say, let me write it over here. Suppose we issue 10,000 shares of $1 par common stock for $30,000. So we issue in 10,000 shares of $1 par common stock for $30,000. How are we going to record that? Well, we're going to debit cash, obviously. And we know we're going to debit cash for the total of $30,000. We also have to credit our common stock. Now, rule of thumb always tell us that common stock will go on the books at the par value. Par value is $1, and it's 10,000 shares. So obviously that's going to give us a common stock amount of $10,000. But as we can see, our debits and credits don't equal, and we still have a paid in capital account that needs to be created. And what's the name of it? Paid in capital excess, keyword, of par. Common stock for the 20. And so that's basically what these two accounts consist of. Whatever you issue above its current par value. The par value never changes neither. So as long as the market is fluctuating the price of the stock, you will always have an increase in paid in capital excess of par accounts. Okay? And that's pretty much the order, guys. You start off with your paid in capital accounts, and then you go to retained earnings. We know retained earnings is an account So you're going to have your retained earnings account after those 4 accounts, and then you get your total stockholders' equity. Now, they do have contra accounts. The stockholders' equity, like treasury stock, we're not going to talk about that much, so you don't have to worry about that. But if you had a treasury stock account, it will come after retained earnings, and it would be subtracted from stockholders' equity. Okay? But never mind that. Just understand this order for your stockholders' equity.